Hello traders and investors, hope you guys are doing well. It's Will back here with another video. In today's video, we're going to go over 10 value stocks that I believe represent some good opportunities for some dip buying as we have had a big sell-off here in the past 2 months. As you can see on the screen here, the SPY is currently still 11% off of our all-time highs, and August and September have been some pretty red months overall. So in today's video, I wanted to present 10 companies that I will heavily be looking into buying over the next coming weeks if these dips do continue. These value stocks are all very, very solid names with solid financials and are at decent technical levels to be picking up, especially if your time horizon is from the next 1 to 10 years plus, guys. So without further ado, let's get into the list right away, guys. The first company that we're going to be going over here is a big one here, SPGI. So this is SNP Global, guys. One of the most underrated and underappreciated stocks by retail in the entire markets, but institutions absolutely love this one. If we take a look here on our terms of our 52-week highs, guys, this is currently trading 25% off of all-time highs, so roughly double the SPY, and we're approaching my technical sweet spot, which would be between $360 to $320, guys. If you don't know what this company does, they have a number of lines of business. So they do credit ratings for any bonds and any stocks. They also deal slightly in mergers and acquisitions advising. They also have proprietary software and data analytics, which represents a big portion of their business that institutions use a lot to value any single instrument. We're talking about commodities, bonds, stocks. Their profit margins and revenues are absolutely ridiculous, but this stock is just not well known by the retail community. However, if you look at their long-term chart, they are an absolute monster in terms of revenue and earnings, guys. So if you see, I did label on the chart here, you can see that on a yearly basis expected here, their expected revenue growth is always 6%, EPS 17% growth year over year. Very, very, very solid company representing a very good dip buying opportunity. If you go over some of the technicals here, some of the fundamentals, right, you will see that although their PE ratio is slightly high because they do deliver on their fundamentals, so they do deserve a little bit of a premium here, you will see also that on an annual basis, increasing revenue every single time. And look at those profit margins, guys. We're talking about 29% profit margins, and this is pretty standard for the company, right? If you take a look at the analyst forecast, you will also see that all analysts covering the stock currently have a price target well above the current price, labeling it as a strong buy. If we take a look at some of our last little financial details here, guys, you will see this company is extremely well positioned. So we went over the revenue, the earnings. They are growing, guys, growing dividend as well. And in terms of the financial health of the company, guys, this is one that usually runs in excess of free cash flow in relation to its debt. The only thing that happened last year is they did acquire one of their competitors here for around $44 billion. And they raised that money through either long-term debt and share dilution as a combo deal, but they did build a whole bunch of brand equity in doing that, guys. So if we take a look here at their debt to equity ratio, you will see that it's actually very, very, very low in comparison, right? So you can see here that they did acquire a lot of long-term debt in making that purchase in 2022, but their equity went up substantially as well, giving them a debt to equity ratio of only 0.3. I'll remind you, anything under 0.1 is very, very bullish. So I like this company. It's one of the strongest names in the entire market. Great technical discount and great fundamentals as well. I will definitely be picking up a few shares of this company should we continue to dip in my little green box here. So that's company number one. Company number two that we're going to go over here is one of SPGI's slight competitors. I say slight because they don't compete in the ratings agency, but they do compete in terms of institutional data analytics. And this one is MSCI, guys. If you don't know about this one as well, it's completely normal. Retail doesn't know about SPGI and MSCI too much, but they're two of the strongest companies in the entire market, guys. All they do is print money for shareholders here. So you can see that we are on a slight technical dip here off of all-time highs. We're off roughly about 25%, just as SPGI. Now, if we do continue to pull back here into the higher 400s, all the way down to my sweet spot, 450 down to 382 off a dip, I will definitely be picking up this company. They have great growth, guys. Revenue growing 9% per year and EPS growing 13% a year. They do pay a dividend. Their PE ratio is slightly high at 45, but since they deliver and since they have so much return on invested capital, this is why they deserve that slightly higher valuation, guys. If you take a look here on the chart, you will see rising revenue every single year and very solid profit margins here. 35, 38% profit margins. Absolutely outstanding for this company. Analyst ratings, even though we do have a couple people below here, roughly in my sweet spot area, 470, you'll see that a lot of analysts are actually above in terms of their price targets, and this stock is labeled to buy. No real red flags with this company at all. If we take a deeper look at their financials here as well, you will see that despite their growing, well, not despite, but in addition to their growing revenue and earnings, guys, right? They do have a solid history of increasing their dividend. And in terms of financial health, guys, they do run a little bit of leverage here, but that's okay. It's offset by the massive equity that they've built in the company here. So you can see that although they do generate about 1.1 billion of free cash flow against their $4.67 billion of long-term debt, it's really not that much, guys. If we pull up the debt to equity ratio, which is the most important ratio here, you will see that although they did add some long-term debt, right, their debt to equity ratio is actually negative here, right? So what that means, guys, is that they've kind of increased their debt and favored a bit of share dilution as well most recently here. But previous to that, right, previous to them expanding their business, this is all these businesses, SPGI and MSCI, they've expanded their businesses through acquisitions recently. So it's normal that although they did issue a bit more shares and issued a bit more debt, they're still sitting in a very, very, very strong financial position here. So although this ratio is negative here, once they start paying off these acquisitions that they've done, right, their debt to equity ratio usually, guys, when they're not expanding their business aggressively, right, their debt to equity ratio on a trailing basis here, you can see that from 2010 to 2016, when this business was running fairly smoothly here, you can see that it was only about 0.5, and then they started really increasing their acquisitions aggressively over the last 6 years as they try and consolidate this whole institutional data analytics business, right? So they are an absolute profit monster, guys, here, right? And I do feel that this is a very, very good company to own for the long term. The long-term chart speaks for itself, guys. It's one of the institution's most favored names here. So that's it pretty much for MSCI. Take a look out for MSCI and SPGI. Very, very, very underrated stocks that I do believe that anybody should have in their portfolios, or at least consider. The third stock on the list here, guys, will be Vich Properties. So here we have a REIT. So what does Vich Properties do? They are the landlord for the MGM suite of hotels, resorts, and golf courses. So basically, when MGM split up their business a few years ago, they moved it into the hotels and tourism business, which is the MGM stock, and now they have Vich stock as being their landlord. So this stock is entirely it's entirely a REIT at this point, guys, right? So you can see that in terms of growth, right, they have a revenue growth of 6.2%, EPS growth of 9.6%. And the beautiful thing about this company is because they are only affiliated with their parent company, MGM, they are increasing rents to their parent company every single year, which has given this chart a very, very, very bullish allure long term. You can see that now we are in a little technical sell-off here, as we are currently 18% off the all-time highs. So more than SPY is off the all-time highs. All the companies on this list will be at a deeper discount than SPY, right? So we're coming into my sweet spot very quickly here, $29 all the way to $26. I do believe that it's a great place to pick up this company, guys. They pay a very hefty dividend, 5.7% dividend yield. Price to earnings ratio is relatively low at 13.57% here, guys. And you can see here, revenue steadily increasing every year with very, very good profit margins. Of course, because they are a REIT, most REITs will have very good profit margins because they don't have a lot of overhead in being the actual landlords here. You can see that in terms of the analyst forecast, they're all heftily above our current price range here. Everybody coming in with a strong buy. And if you want to take a look at more financials here, guys, you will see that in addition to their increasing revenue and increasing net income every year, they do have a lot of long-term debt, however, right? This is completely normal, guys, right? Most REITs will run a high amount of debt because of the business that they're in, right? They're in the real estate business, guys. So once they have to leverage debt here against their properties to then collect the rents, it's absolutely normal that you will find high levels of debt in every single REIT that you do look into. The key factor here is, are they bringing in cash flow? And this company is bringing in cash flow. And despite the recession that's potentially going to hit the housing market, most of their exposure being in the entertainment business, guys, you guys know that entertainment has been booming and will probably still be quite hefty in 2023 and 2024 as well. So they will be able to continuously generate very decent cash flows here against their properties and continuously pay down these long-term loans and potentially only have to refinance here once rates have come lower. In my opinion, this is actually one of the best positioned REITs here in the entire market here, just because of what they're exposed to. And if you take a look at their debt to equity ratio, right? So how much equity they've built against all of these properties from principal pay down and whatnot, you can see that their debt to equity ratio, even though they have a lot of long-term debt, their shareholder equity is very high, giving them a debt to equity ratio of only 0.69. That is very good. So if you only look at the debt, it is not the full story. Their equity is in a very solid position. So this is pretty much the only REIT that I'm looking to acquire here in these lower levels. It represents a very good discount. Company number 4, we're going to look at Nike here. Nike, household name, shouldn't have to explain this to anyone here. Nike currently in a very solid dip, right? So Nike currently 46% off of the all-time highs. Nike's been one that, despite all of the issues that they may face over in time, they do continue to add shareholder value every single year, and they have an absolutely massive brand value currently, right? So their growth rate currently still sitting at a very healthy 6.5% per year and EPS growth at 12.6%. This company is now trading at a 27 PE ratio. Not very high, not very low either, but considering the amount that they have dropped and the area that they're in, very good area of technical support. You can see that they bottomed here last September, and then you'd have to go back to 2020 prices to obtain this same price level, right? But over that time, they've actually increased revenue, right? So continuously increasing revenue, very decent profit margins for an apparel seller, right? Right around 10% here. And let's take a look at the forecasts. You will see that most analysts forecast, if they're not currently around the price range or in my sweet spot, they are all above, right? So only 2 analysts with the sell rating on this around the $88 mark. Everybody else has a buy and has the stock going higher. So if we continue to trend down into the $80 range, I do believe that this is a very healthy position to pick up Nike in. And we'll take a look at our more financials here. You can see increasing revenue and very steady profit margins, increasing EPS, right? This is what matters, right? Earnings per share is key. You will see that they do pull in a very decent amount of free cash flow and that they do still have cash to pay down their long-term debt obligations, right? So Nike here also representing a good deal in terms of debt to equity, guys. Not a very sizable amount of debt to equity at all, 0.64 as a matter of fact. So not a lot. So even though they have added some long-term debt, as they've struggled here with a lot of inventory issues here in the past 2 years, right? And they've had to take kind of debt to mitigate a lot of issues that they've been having with supply chains and whatnot. You can see that their debt to equity ratio, guys, is fairly low. They have been bringing it down ever since they went through that little mishap here in 2020, like a lot of companies did, right? And now, guys, they've been able to raise shareholder equity once again, giving them a very fair debt to equity ratio. It is higher than it has been in the past, yes, but then again, guys, this stock is at a very decent discount as well, right? So a little bit of a trade-off there, but I do believe it's a great opportunity to pick up this company. This company has not been this cheap in a very long time, right? You had to snipe it back here last year, and if that wasn't it for you, you would have had to buy it really back here in the 2020 crisis. So very strong company, in my opinion. Nike will have no problem here in the next 5 to 10 years as their brand loyalty speaks for itself, right? And now let's move on to the 5th company here. We'll move on to Louis Vuitton, guys. Not a lot of people ever talking about this stock, but it's one of the strongest stocks in the stock market and one of my favorite players right now. Louis Vuitton is a conglomerate at this point. It is not only Louis Vuitton. They own over 70 70 luxury brands that a lot of you may know very well, right? Dior, Tiffany's, they own a lot. You can look into it for yourselves. And now we find ourselves in a little bit of a technical dip, right? So nice little dip here off the all-time highs, currently sitting 25% off the all-time highs. Heavy momentum to the downside. And even on the daily, you can see RSI is getting a little bit oversold. And we're coming down here into our previous all-time high area, which should be acting as some good support. This is a nice monthly pullback that I've been eyeing for a while. I did start adding shares here in the 150s. But if we do continue to drop a bit lower, I will be adding more shares, guys. This company is an absolute monster. They pay a 1.35% dividend yield. They do have a very low valuation here of 22 current PE. And considering their growth here, revenue 6.8% growth year over year and EPS growth 13.4, the next year's price to earnings is actually below 20. So very decent as a whole. You can see that they increase revenue every single year. And being an apparel provider, right, even in the luxury segment, usually luxury segments don't lose that much money during recessions. So this stock could prove to be more recession proof than others here. You can see profit margins in the 18%. If you want to take a look at the analyst forecasts here, you will see that every single analyst in the book has this at a overweight and strong buy rating because of how well they are going to deliver in the next few years, guys. So very bullish on these price targets here from the analysts. And if you want to take a look at their financials here, guys, you will see that increasing revenue, increasing earnings as well. And although they do have a bit of debt here, look at that free cash flow, guys. Absolute free cash flow monster. And they do still have a bit of cash and cash equivalents on the side, but usually they are using that regularly to acquire competition and solidify their conglomerate status as one of the largest luxury good retailers in the world. So they are really trying to corner the market by acquiring a lot of their competition. If you want to take a look at their debt to equity ratio here, you will see that also Louis Vuitton, I mean, really not that bad either, right? So they have, despite the fact that they do have a little bit of a long-term debt uptick here, right? In the past couple of years, you will see that what are they doing with that debt? They are building massive brand equity, guys. Massive brand equity. Debt to equity ratio only 0.15. That is crazy. This is why it's one of my favorite value stocks in the entire game right now and representing a very good level to pick up some shares. I think this company will perform beautifully over the next 5 to 10 years. And today could be a very good area to pick it up, which is why I've done so myself here. Now, let's get on to the next one. Sixth stock here. American Express. So this also should need no introduction. Credit card company most known for US sales, but they are very worldwide as well. You can see a bit of a technical sell-off here as well. 25% off of our all-time highs, coming down in my sweet spot, guys. Previous support area. Very solid area indeed. 150 down to about 131. This stock also just continuously grows every single year. Very loyal customer base. Bit more of an upscale customer base, which does help as usually their clients tend to, they don't restrict their spending as much during recessions here. So you will see their price to earnings ratio is only 15.27 and they do pay a dividend. Compare that with MasterCard, right? If you compare that with MasterCard sitting at a 37 PE ratio and Visa also sitting at 29 PE ratio. So American Express, one of the cheaper credit card issuers, a very loyal customer base indeed. You can see that continuously increasing revenues, except for 2020, 2021 for obvious reasons, right? Nobody was able to pretty much go outside and do things. But now that entertainment and travel has been resumed, well, obviously their margins have come right back up to where they used to be, right? Running around 15% profit margins, right? Insane revenue growth and net income here. You'll see that on a 1-year price target, although a few analysts do have targets down to the lower end of my sweet spot here. Many of them, most of them, as a matter of fact, are indeed above here. So stock is still labeled as a buy by the broad market Wall Street analysts here. And you can see that even they have increasing revenue, increasing earnings over the next since the past few years and over the next few years as well. Their financial health is very good, guys. They've paid down a lot of debt in the past few years. Free cash flow monster. Look at that, guys. $19 billion in free cash flow, $33 billion in cash and cash equivalents. So they could pay down a bunch of this debt if they wanted to. Very solid company. If you look at the debt to equity ratio, guys, which is one of my favorite ratios to look at, you will see that in the last 10 years, they have been steadily bringing it down and down here. The debt to equity ratio is only 1.75 right now, but like I showed you, they can pay it down with a lot of their cash and cash equivalents. Compare this to MasterCard and Visa. You'll see that MasterCard and Visa are somewhat in the same position, right? MasterCard actually running a 2.5 debt to equity ratio here, although they do have a lot of cash on hand as well. And Visa running slightly lower debt to equity ratio here, around 0.53. So American Express here really right in the middle of those two companies here at around 1.75. But I do like this downtrend, and they do have so much cash and cash equivalents on hand, and their free cash flow is monstrous per year, that their long-term debt is really not a big issue for me here. So if it does pull down further into this area, I'm definitely looking to pick up some shares of American Express. Very, very nice wide range here over the past 2 years and coming down into the lower part of it. Now, the seventh stock that I want to take a look at, guys, is Public Storage. So this is pretty much the second REIT, although it's a very niche REIT, kind of like Vich. This is why I like it, right? They only do public storage, and you guys know that public storage in the last 10 years has been a growing trend here. And public storage has spent a lot of money in the past 3 to 4 years to acquire a lot of smaller competitors here, really solidifying themselves as one of the largest players in the game in North America currently. So growth stays put here at revenue 5% year over year, and EPS growth at 10.4%, guys. This company is trading at a very fair valuation, only 11.45 price to earnings. Very nice dividend yield, if I do say so myself, 4.55%. If you take a look down here, guys, ever expanding revenue and ever expanding net income as well. Traditionally to a REIT, this is an outlier here since they did raise some capital here over the course of the year. So this is a bit of an outlier here, but usually they do perform in roughly the 45 to 50 plus profit margin rate here. And if you take a look at our analyst forecasts here, you will see that although a few analysts do have price targets down into the 250s, right? My area here, 275 all the way down to 241, you'll see that currently off of all-time highs, guys, 37%. And we're currently tapping into our previous all-time highs from 2019 as support. So if we continue dropping in this area, I will be picking up some shares here. Moving back to the financials real quick, right? So ever expanding revenue, ever expanding net income. That's very good. Earnings going up, revenue going up. They do have a decent amount of long-term debt since they are in the real estate business as well. But you can see that their free cash flow that they generate per year is a very fair amount. Their cash and cash equivalents has been low over the past 5 years, as I've said, because they have been busy acquiring competition. So not only do they pay out the cash in terms of dividends, but they also acquire tons of different competitors as well. So public storage here on the debt to equity ratio, you'll see that it's a bit high as they've had to leverage a bit more debt from their acquisitions ever since 2018, right? But in the process, that's what you can see here. As soon as they acquire people, their equity goes up. It's normal. The company is growing. They have more and more brand equity under their belt. So even though the ratio has come up here significantly since 2018, it is still only sitting at 0.68. Very, very healthy company for the long term, in my opinion here. Very healthy technical discount as well, guys. I would not be surprised here if public storage is able to really recover nicely here as soon as obviously interest rates peak. That's going to be good for the rates and for the REITs. And as soon as rates do come down, guys, this one should have no problem flying whatsoever. It's been fairly muted here over the past 2 years. Very, very decent buying opportunity in my opinion for this. And now on the 8th position, we have one of our financial companies here, Charles Schwab. Now, let me preface this. Why have the banks been doing bad, guys? What's very, very obvious here, banks are in the business of drafting loans. Now, when interest rates are high and mortgages are 6.5%, 7.5%, and private loans are high, obviously not a lot of people want to finance things at high rates. That includes mortgages, it includes new cars, it includes private loans, it includes commercial loans, right? So obviously the banks have been taking a big hit. Why do I like Charles Schwab? Because their profit margins are very high and they're able to diversify away from their banking business with their very heavy brokerage business. So Charles Schwab has now merged with TD Ameritrade, and they are now the largest broker by volume in North America. So that is very, very, very good for them. The profit margins in the brokerage business are absolutely outstanding, and that's what gives this company a little bit of an X factor, in my opinion here. So Charles Schwab currently down 42% off of all-time highs. And you can see, guys, that this company does pretty much grow very, very, very well. And ever since they've been expanding and growing their trading business, well, they've been benefiting from a substantial run. You can see that a lot of this run here in 2020, late 2020, was from the ever expanding trading business and generating a lot of fee and commissions here from stock market trades here. So their growth is set at around 7.8% per year, which is fair, and EPS growth at around 14.5%. Valuation low, 15.85%. Price to earnings ratio. They do pay a dividend, 1.82%, and we are currently coming down in my sweet spot here. If we continue trending lower into the low $50 and high 40s, I will be picking up some shares of this company, as it is one of my favorite financial companies on the entire market right now. So very, very good dip opportunity here. Ever expanding revenue and net income here. You can see their profit margins ever since that merger there, they've been able to increase profit margins into the 30% and really expand revenue. And that's not considered. That's not going to be slowing down for consideration here in the next 2 to 5 years. You can see analyst forecast all above current price right now. Love to see it here. Very, very good buy rating by most analysts here as well. And if you want to take a look at the more financial section, yes, we have ever expanding revenue, expanding net income here, right? Dividend history has been on the increase here. And look at this, guys. Debt to equity is phenomenal, absolutely phenomenal, and has been for the last 5 years, right? So you can see that of 2022, their debt, even though they had a lot of debt here at 38 billion, their cash and cash equivalents is more. So they generate about $2 billion of free cash flow per year, and now their cash equivalents is very, very, very solid here. If you want me to put it on the debt to equity ratio, guys, you will see that Charles Schwab is running a fair amount here, right? So only 0.61% debt to equity, right? Very, very solid number as well. You can see that they did increase their long-term debt here as they went through the acquisitions here of smaller brokerages and TD Ameritrade here, and their equity has benefited tremendously from that as well. You can see it dip ever so slightly because share price has declined as well here, but their debt to equity ratio, guys, is really nothing to scream about, nothing to be worried about in my opinion here. Very, very, very solid company at a nice, attractive price. So that's pretty much it for Charles Schwab. And now ninth, we're going to have a bit of a duo here. And the duo is Pepsi and Coca-Cola here. So Pepsi, nice little dip coming into Pepsi here. Look at this long-term chart on Pepsi. It looks like Coca-Cola. Pepsi has always been able to deliver, guys. They do have pricing power. They get through recessions just fine, as their drink and chips and just general snacking business, right, is absolutely massive. And they do have a lot of sponsorship deals with sporting events as well, such as Gatorade and the likes, right? So Pepsi currently running a dip of about 15% off of our all-time highs, guys. You can see coming nicely into our previous support here, guys. This is a year and a half's worth of support. So if we dip into the lower 170s down to 155-ish, I will definitely be picking up some shares of Pepsi. Growth, 4.4% revenue per year. EPS growth, 11.4% as well. You can see that Pepsi running currently a nice 3% dividend, very, very healthy. Price to earnings is 29.72, and they're very well positioned, guys, increasing revenue every single year like a true boomer stock should. Profit margins, decent profit margins, guys, sitting around 10%, right? You can see the analyst forecasts here for the next foreseeable future, all the way down to my sweet spot, 155, right? And most of the analysts here either have it as a hold or an increase on price into the 200s here. So they will be increasing revenue over the next couple of years. They will be expanding EPS as well. If you take a look at the more financials here, guys, you will see that although even though they're increasing revenue and net earnings here, their dividend just steadily increases here, and they are running a decent amount of debt, guys. This is a company that's running a lot of debt, as a matter of fact, in relation to its free cash flow and cash equivalents section here. But that's always been the case for Pepsi. Coca-Cola is a bit the same here. But if you put it in relation here, that means nothing on its own, right? We have to look at things on a relative basis here. You will see that their debt to equity ratio here is 2, right? So even though they're running substantially more debt than their actual free cash flow and cash equivalents here, their debt to equity ratio is only 2. So Pepsi has always used, as you can see in the past 10 years, they've always been using debt to ever expand their market share. It's completely normal here, right? You can see that the long-term debt pattern is ever increasing. So that is the one little caveat to this stock, is they do run a little bit higher debt than usual here to expand their business, but no real red flags for this company as a whole. If you want me to compare it with Coca-Cola, Coca-Cola is running roughly the same, right? About 16% off of all-time highs. Come down into my sweet spot here, 55 all the way to 51. This will be a very good pickup for me. They also run around 3% dividend. Price to earnings is lower than Pepsi, so could be considered a more decent buy, especially if we come down here into my sweet spot zone. Revenue 4.8%, EPS 7.8%. So a bit lower than Pepsi as a whole, right? But Still very, very decent growth. Earnings also increasing here. Profit margins are a lot better than Pepsi's, however, right? So their profit margins, 22%, guys, even as high as 25% in 2021. So very, very good by Coca-Cola. You can see analyst forecasts are all above current price. As a matter of fact, strong buy, a bit better than Pepsi in my opinion here. It's really up to you which one you want. I may do a little bit of both here. In terms of the more financials, you will also see that Coca-Cola runs pretty much the same mix as Pepsi here, running slightly less leverage, but you can see a lot more debt than they do have free cash flow and cash equivalents, but nothing really terrible, right? Increasing dividend every single year in terms of dividend per share here. Very, very healthy company as a whole. And you will see that Coca-Cola is roughly in the same position here as Pepsi. They do run a debt to equity ratio of around 1.29. So lower than Pepsi, but still above 1, right? These are companies that do need to run a decent amount of debt here to continue increasing brand awareness and continue increasing market share, right? So really good competition amongst each other, and they will grow both equally, right? But I'm just looking for the one with the best discount. We will see whether that's Coke or Pepsi, but both really good buys in my opinion. And now lastly, guys, John Deere in 10th position, guys. John Deere here, even though they don't represent a very decent sell-off from the all-time highs, only about 16%. If we come down to my sweet spot here, which is pretty much a year, almost 2+ years, if we would come down into the 350 range, right? If we come down into here, I'll definitely be picking up some shares of John Deere. Why? Revenue growth, 6.8% per year. EPS growth, 14.2%. Look at this valuation, guys. 11.37 price to earnings ratio. It's pretty much the lowest it's been in 10 years. If you want me to pull it up here, look at this. John Deere PE ratio history here. I didn't have it pulled up. I apologize for that. So you'll see it with me, right? Their PE ratio, guys, they're at the lowest that they've been almost in 10 years. 11.17. Look at this downtrend here. You can see, right? You'd have to go back to 2015 to find a PE ratio this low, and the stock price isn't that much off all-time highs. Why? Because they've been increasing revenue and increasing net income very nicely in the past 2 to 3 years, guys. Very good revenue and earnings expansion here. If you take a look here, guys, right, they do pay a slight dividend here as well, 1.43%. Low valuation. If you take a look at the analyst forecast, look at this. Every single one, guys, has it rated pretty much over our current price. So the lower we dip here into the 350s is a heavy buy for me, right? And they will be growing over the next few years. John Deere, one of the world's leaders in heavy equipment and tractor manufacturing supplies, right? They also have subscription services here for obviously repairs and maintenance. They do a great job of upselling that. So that's where a lot of their profit margin does come from. Indeed, no red flags with this company whatsoever, guys. It's one of my favorite companies in the market. Also one that people don't pay that much attention to here. So expanding growth, expanding revenue as well, expanding dividend history too, but they do run a heavy amount of debt here. You can see, guys, that cash and cash equivalents, not too high, and free cash flow numbers, not too high as well, right? It's an expensive business to run. This is the only thing that has a bit of a red flag on it, in my opinion, but John Deere has always been that way, guys. You can take a look here, right, that their debt to equity ratio always in the past 10, 15 years fluctuates between 2 and 3 at the highest, but now it's actually on a substantial downtrend here. So if I move myself over here, you can see it's now down to about 1.65. So they have so much equity built up in the company now, guys, that it's very, very good to bring down their debt to equity ratio. So this is only half the picture. You have to look at how much equity they've been able to build for shareholders, and it is substantial. As you can see here, guys, lowest it's been in the last 10, 15 years. So that's why it's a buy, guys. Debt to equity ratio has been coming down very nicely. Their revenue and earnings are expanding here, right? And their PE ratio, as I've shown, guys, their PE ratio is at the lowest as well. It's been in pretty much the last 10 years. So that's why John Deere, even though they're not that much at a share price discount, their fundamentals are looking very solid for continued run-up. And this company needs no introduction. They just continue to rise and rise and rise over time. So that's pretty much all the stocks that I had for you today, guys. I hope you enjoyed the video. I hope that you are writing some of this down. And if you do appreciate some stocks, maybe you will join me in buying the dip as well here. So if you did enjoy the video, consider liking, consider subscribing to the channel if you're new here. We always do our daily market updates every single day, Monday to Friday after the close. And we do put out some videos on stock specific things like this as well. And I will be putting out more videos on my options strategy that I also run as well. I do have one on the channel. If you click on my channel on the home, it should be the featured video there. I run it every single week. We run the options wheel, all right? So if you have any questions for this video, guys, always feel free to ask me down below in the comments. Hope you appreciated everything here, and happy dip buying to everybody. The next video I'll be releasing is the 10 growth stocks. So keep an eye on that in the next few days. So take care, guys, as always. Happy trading and peace.